Hey, everybody. Welcome. Okay, stop the clapping. Our live audience is too enthusiastic. Welcome, everybody. Happy Wednesday to all of you. And, you know, in the old days, they used to call Wednesday hump day. Adam, have you heard that expression?
Oh, yeah, absolutely.
It's the middle of the week. So here we go. So happy hump day. And Adam, welcome to you. And wow, a lot of big companies are leaving the Socialist Republic of California. The latest is Oracle. I heard a funny thing the other day. Some consider Elon Musk to be like the smartest man, right? and this funny thing was the smartest man left the state with the dumbest governor. He moved to your state. He moved to Texas, left California, my old state, and here we are. And now Oracle is moving their headquarters to Texas as well. Big changes, huh, Adam?
Yeah, pretty big changes. It should be interesting, though. They did say that they were moving, but they're not taking their workforce. They're not leaving their workforce behind necessarily.
Well, I think this stuff is not always what it seems, right? But it definitely shows the direction and the trend, and the future plans. You know, what they do is this doesn't come all at once. These moves happen over time and stages. It's too shocking to do it all at once. So this is a stage, right? It's happening.
Yeah, this is one of those, it's an amazing time to be alive, and it's an amazing time to be a business owner, and that you can just leave California, go to Texas, and keep your California employees.
Yes, you can. Technology has enabled a lot of this movement, and it is an amazing time to be alive, definitely. So what do you have for us today? We're going to talk about that, but we've got a lot to talk about, so let me get through some slides here. If you need us, reach out, jasonhartman.com. Or in the USA, you can call us on the good old-fashioned telephone at 1-800-HARTMAN. We'll be happy to help you build a nationwide income property portfolio. And we're going to talk about responsible markets and maybe new ways to build homes. This has been in the news for 10 years or so, new building, new really innovative construction techniques. They don't seem to be catching on much, but we'll see. And yes, the companies are on the move. So let's dig in, Adam. But before we do, want to remind everybody that income property is the ideal investment because it offers income, as the name would imply. It offers depreciation as a good thing. That's a tax benefit. Depreciation is the holy grail, the best of all the tax benefits, because it is a non-cash write-off. It is something you don't need to write a check to get. And this is why so many very wealthy people can lower their tax bill dramatically or even get it down to zero because of depreciation. Income property is the most tax. What's that?
Or $750.
As with Donald Trump. Yes, absolutely. You can comment on that in a second. That's good. But depreciation is one of the things that makes income property the most tax-favored asset class in America. Most tax-favored asset class in America, when taxes are the single largest expense in any of our lives. Equity growth, appreciation, and leverages a very powerful tool, allows you to do more with less. And those are some of the great things about income property. So yes, Donald Trump did what the IRS incentivizes all of us to do. Be a real estate investor, provide housing, and you can be a billionaire and pay $750 in taxes.
Yep. Absolutely. And you might think that I'd get upset about that since you know my views, but if you know my view about taxes, you know that I have absolutely no issue with him paying little to no tax if it's, as long as he did it legally, which seems like he did based on what I heard. So
yeah, absolutely. Absolutely. Well, hey folks, tell us where you're watching and listening from. Make a comment below and tell us where you're watching and listening, and tell us if you think Donald Trump did the right thing on his taxes or if Donald Trump was cheating on his taxes. And I bet this will be split right down the political aisle. Regardless of the truth, it will be Democrats will say Donald Trump is a scumbag and a cheater, and Republicans will say, nah, he did the right thing. He's a real estate investor. That's what the law allows. So.
And let us know if you're a CPA and you've read it, and we'd love to hear your thoughts too.
Yes, we would definitely like to know. Comment below, please, if someone actually reviewed Trump's tax returns, and we'd love your comments on that. But hey, let us know where you're listening or watching from. Comment below, folks. We know you're watching. We can see you out there. So it's time to start typing. All right, Adam, go for it.
So this is what I was talking about before with the Oracle. Even though Oracle's talking about leaving, it says a bulk of employees can choose their office location or continue to work from home part-time or full-time, the company said. So this is really the thing that, as we talk about the work from home revolution, it's impacting businesses in a way that it never has before, because Oracle doesn't have to worry about leaving their office space in California. They can get away, get to Texas, and do all of that and still maintain their employees and still maintain that in the continuity that comes with that. So this is a really big thing that is going to hurt states like California, who businesses are not fond of. And eventually they're going to have to realize that they're going to need to change up some of their methodology for revenue in the future.
Yeah, that's for sure. So California has been chasing businesses out for many years, and that trend continues as the world's dumbest governor, Gavin Newsom, just drives them out. But Adam, just speculate with us for a moment. What do you think they're going to do? I mean, where are they going to get revenue from when their tax base keeps declining? And remember, folks, this is income tax base, sales tax base, because if those people don't live there and they're not buying stuff there, sales tax revenue goes down. But also, and maybe most importantly, property tax base, as the valuation of properties goes down because offices are vacant, homes are sold, there's less development. That lowers the property tax base, which is hugely significant. Speculate with us, Adam. I mean, look, you're a Democrat. You're my favorite Democrat. Where are they going to get the money from?
That is a very good question. I mean, they're in a completely different situation than the federal government because they actually rely on tax money. So it's
versus explain what you mean by that.
Okay, that's important. I mean, the federal government can theoretically print and give out as much money as they need to pay for things. I mean, you can debate whether that causes inflation or what it does to the economy. That's fine. You can do that all you want. But the simple truth is they can make as many dollars as they want.
Yeah.
States can't do that. That was part of joining the union. We realized every state having its own currency is an absolute nightmare. You have to use the federal dollar. And then they are actually reliant on property taxes, on income taxes, on sales taxes, everything to pay for it. So they can't just say, we're going to build, we're going to fix that highway over there and we're just going to create $1 billion to do it. They have to find the $1 billion to do it. So,
right.
They're going to have to take a hard look at what they're actually giving their citizens in terms of, where they're spending their money, and see if it's a feasible thing to continue doing based on their expected income, or they're going to have to go begging the federal government. And based on what I've seen in the Republican majority, they're going to be left with their hat in their hands. So, it's going to be hard for them. I mean, honestly, if you're losing businesses and you're losing your income, they're going to have to tighten the belt.
Yeah, no question about it. But they've been in a precarious situation for a long time now. If we do see sleepy Joe Biden and communist Kamala Harris in the White House, I think there's a much bigger chance they can get a bailout. There could be a California bailout. But what Adam was talking about really goes to a core concept, which is, of course, the federal government can create fiat money out of thin air. And that begs the question, if a government, any government, can create its own currency out of thin air, with not being tethered to gold or anything else for that matter, then why do we need a taxing agency? The Internal Revenue Service was founded right after the Federal Reserve was founded in rapid succession, just over 100 years ago. Both of them, both agencies, and if you have a central bank and in cahoots with the Treasury, you can create money out of thin air. And of course, with Bretton Woods, we're off the gold standard as of 1971. That was the last tie to gold. Then why not just tax the citizens through inflation? Now, I know some of you may, oh my God, that's sacrilegious, it's terrible. But it is a valid academic question, because inflation is a tax, and then so is your tax bill that you pay to the IRS, right? But why have both? Well, I'll answer my own question. It's rhetorical, just because it's a better way to deceive the populace by having both taxes.
There's also the fact there's two key reasons. Number one, you do it to create a demand for your currency. I need dollars.
Now we're getting into modern monetary theory here, folks.
Well, I mean, think about it. If I didn't owe taxes in the US dollar, I wouldn't care as much about getting paid in the US dollar, about keeping US dollars. I wouldn't care about that as much. So maybe I would take pounds, or maybe I would take Australian dollars in payment if it was stronger related to the dollar. And that at that point, it might be a smart business move. But dealing with currency exchanges and paying taxes, I mean, I can't send in British pounds to, pounds sterling to pay my taxes. They'll send it back to me. Well, they might send it back to me and say, you still owe us, $10,000 for your taxes. So
right, and you can't pay it in gold or Bitcoin or any other currency. And that is one of the fascinating things about MMT, or modern monetary theory, which I know that you like and I think is a fantasy. But regardless of that debate, that's for another day. MMT, interestingly, does create demand for a country's own currency. It's this really cool closed ecosystem they've created for themselves. It's a great business plan. It really is. I got to give them credit for that. But the other thing that creates huge demand for dollars around the world is the fact, everybody likes to say the US is the biggest debtor nation and talk about how much debt we have. And that's true. But also, the US is the biggest lender nation. And all of those loans that are foreign loans have to be repaid in, guess what? Dollars. And that creates a huge demand for dollars. So it is a fantastic system they've set up for themselves, isn't it?
So the other reason you need taxes is just to flat out take money and demand out of the economy. If you've got too much money in circulation, you can tax it back and help stave off any potential future inflation. So, I mean, it is still needed. They can do, they don't need it, but they can still be helpful.
Okay, so you need taxes to take money out of the system to cool inflationary pressures. Is that what you're saying?
Yeah, you take it out to make sure that there's not more money chasing the same amount of goods, right, and creating too much of a demand for the products, and that you stay under your productive capacity as a society, or at your productive capacity, and limit the chance of like a hyperinflation.
I'm going to share a chart with you folks later, because you will not believe this. The amount of money, I mean, if you think our government or our central bank is worried about inflation, I can't believe it, because the amount of, not money, but fiat currency that's been created just this year is absolutely staggering. I'm going to show you the chart, folks. So stick with us. We'll get to it. Let's jump back into this, though. Whoops. Oh, there we go.
I'd like to touch on what Jason Keys says here, which is going to be interesting. And Jason said, I see California starting some new loophole or law where they tax a company based on their employees' working location. And that's going to be very interesting, because California is trying to do that already.
Yep.
They're trying to tax companies for, I think it's 10 years after they leave the state. Right. And that's going to go through the court system, and I'm 95% sure they're going to lose that badly.
That seems that just smacks of so unconstitutional. But
Oh yeah.
folks, this is what I predicted back over 10 years ago, that California would build an economic Berlin Wall. You know, the first time I've ever visited Berlin, I've been there a few times, but the first time I visited, I spent 6 hours, honestly tearing up in Checkpoint Charlie, the museum, where it was a crossing point from east to west Berlin, or west to east mostly. It's just unbelievable what they did in building that Berlin Wall, because there was a brain drain. And California is experiencing a similar thing. So is New York. So are all these unfriendly jurisdictions. And they're trying to build an economic Berlin Wall. It's invisible, but the long arm of the law, the long arm of the franchise tax board, will get you. And they're trying to, I can't imagine they're going to win that, but with some of these crazy activist judges we have today, you just never know. It's really scary. Anyway, let me mention. So you mentioned Jason Key's comment. Jason's a good guy, really smart commercial real estate broker in California, thinking about leaving California. I know he's working on that. Will is watching from Iowa. Welcome, Will. And you said that Donald Trump was doing it by the book. I agree with you. That's the incentives that you get. Peter is in the Colorado Rocky Mountains. Oh, I love the Rocky Mountains. You make me think of John Denver and Aspen, Colorado. It's so beautiful. Rocky Mountain High. What does he say, Adam? Peter?
He said, the Trump tax issue was scary, but nobody caught on. As long as people think that he is a cheat, we are now at risk of losing our tax breaks. Which
there we go.
We could be. I mean, Biden's talked about the 1031 tax deferred exchange and maybe getting rid of it, but that's going to be a whole big, long process. And I'm not too concerned about it, but it could always happen.
It could happen, and that would be really scary. We've got Brent from Melbourne Beach. I'm thinking you're saying Melbourne Beach, Florida, because you've got a rocket ship there, and that's near the Space Coast. And Trump taxes and good stuff. And Brent says Bitcoin $20,000. We'll see. We'll see. Maybe even more, but highly speculative. So be really careful. Adam, what do you want to tell us about growing the housing supply? Because there is a major housing shortage.
There is a massive housing shortage. And I read this on Housing Wire, and I never thought about doing it this way. And financing, this is talking about the financing for building. And it's a really interesting idea, because you talked about the housing supply recently on the podcast, and we're down to, I believe it's 3.3 months of supply in the economy. This is a chart from the Federal Reserve of St. Louis, I believe. And they show the supply. And right now, if you go to the next slide, you can actually see the numbers.
Yeah. And just so you know, for a reference point, a somewhat balanced market is about 6 months of supply, meaning with the absorption rate staying the same, the existing housing supply, if nothing new comes on the market, would be absorbed in about 6 months. Now, just remember something, even 3 months or 3.3, as in this example on the screen, is very low supply, because some of these properties will never sell. They're absolute shacks. Okay. And, some of the housing supply just needs to be redone. It's obsolescent. Tell us about this, Adam.
Yeah. So I'll give you just an anecdotal story. Right now in Austin, the neighborhood where I'm in, Jason, guess how many homes are available to purchase today?
Well, how many are in your neighborhood? That's my first question, because I want to know compared to what?
In the little suburb division that I'm in, let's go with 3,000.
Okay, 3,000. So I've been to your house before. You live in a nice neighborhood, outside of the Austin sort of downtown area. And with 3,000 homes in your neighborhood, I'm going to guess there are like 20.
Zero.
Oh my gosh, nothing.
Yeah,
wow.
There was one house that was available for sale, and it went under contract about 3 or 4 days ago, I believe, and there's been nothing. So there's no inventory here in this neighborhood. There's very little anywhere in town, but in the suburbs, there's zero. So they're talking about the builder inventory. the monthly home supply is currently at 3.3 months. And they say on the Housing Wire article that builders like to see 6.5 months or less to have confidence to continue building. So right now, we're going to see what this is telling me is we're going to see a lot more builders willing to build, until we can get up to the supply, the 6.5 months, because that's, double the supply we have now, essentially.
Right.
So we're looking, and you talked about it in the podcast recently, that we just haven't been building homes.
No,
it just hasn't been done for 12, 13, 14 years.
Yeah, the episode yesterday and the day before, the 2 episodes I did with Dan Ferris at Stansberry Research were really interesting, and I've got some other really good ones in the can, so to speak, that we're going to be publishing maybe next week, and about this topic, because we've got to remember that even when we look at these supply numbers, it does not address the type of supply. Okay, the price segment of that supply, the location of that supply. It's a very large country. And the one thing we know for absolute sure is lower priced workforce affordable housing is just not being built at all. None, nada, niet, whatever you want to say, right? There's just nothing, because it makes no economic sense to build it with all of the regulations, the environmental impact reports, the construction requirements. You can't afford to build it. No, it does not work. It does not pencil. Builders cannot deliver houses for the prices of the resale inventory that you would find at jasonhartman.com/properties right now. And there's very little of that, by the way, because massive inventory shortage for us too. But they can't deliver those properties. So think about that. You are buying something, potentially, hopefully you're buying it. Go to jasonhartman.com/properties. Shameless self-promotion. Hey, what do you think? Let's give a sound effect for that.
It's self-promotion, but it's still true.
It's true. It's absolutely true. You're buying something that cannot be replicated again. I mean, you're buying something nobody's building again.
Yeah, we showed it. If you go back about 5 or 6 of our live streams ago, there was a chart that I showed that had the new homes built in the price ranges, and the under 200,000 was like 8% of homes or something like that. It was really, really low. And you were talking about the homes that can't be replaced. The unsold inventory, which is the bottom half of this slide, the unsold inventory is at an all-time low of 2.5 months.
Wow.
It's down from 2.7 months in September and down from 3.9 months from a year ago, October. So it just, you think the new home 3.3 months is bad. The existing homes really don't exist. At this point in time.
Yeah, and there's the chart for you. By the way, this article that you're referencing was done by Logan, who's been on the podcast a few times. He's one of my Facebook friends. He might be watching. Hi, Logan, if you're watching. And he really does some great analysis on this stuff. And so this chart is from the St. Louis Federal Reserve, but he did the marking on it. But it really illustrates the amount of supply. You see here, during the Great Recession, supply got really high going into it. This was the dangerous thing. It was getting really high going into that Great Recession. And then you saw zero building. So supply did get absorbed. Eventually it took a little time to work through, but it got absorbed. And then, we see a little up and down here, but ever since about, 2012, here's where we've been. And, it might sound like a broken record because, Adam, seriously, for 8 years, we have been complaining at my company about an inventory shortage. But now it's just worse than ever, because notice the problem with this chart is it needs to almost expand out past the end. Is that this, I don't know if you can see this very well on the chart where my mouse is, but this line is down here. I mean, folks, do you see that? It only dipped this low or even close to this low a couple of times, okay? Here and here, and that's it. Way back to 1962, right? I have to look around my screen, my laptop screen, to even see on the chart. It's just totally incredible. Okay, tell us about origination.
The thing that he talks about in the article that's really an interesting theory is, what if essentially governments, the federal government, financed these builds? So in my mind, I think he was talking about kind of destroying the hard money lending in a lot of ways, but the government financing the builders and giving them the money with the lower interest rates in order to build the homes that we're saying that we need. And it was a very interesting idea that I had never really thought of. Is the government has obviously gotten into, loan originations and, Fannie and Freddie backing all of these loans, but what if they got into the actual construction side and started getting into that market? It was an interesting thought experiment.
Well, since the government is just in like every area of our lives and economy right now, I wouldn't doubt that at all. That wouldn't surprise me really at all. So, yeah. Okay. Mortgage originations. I mean, mortgage people are making ungodly amounts of money right now. They're making fortunes. So, congratulations to the mortgage people. Let's give them a cha-ching. There they go. They're making fortune. Mortgage companies are killing it right now.
Yeah, so this is also just looking at the kind of the strength of the housing market and the homeowners today. If you look at it, and if you think about it in terms of credit scores and risk, if you look at how we've been lending in the past few years, and especially nowadays, that light blue is your highest credit score, and it's 65 to 70% of the total loans that have been given, I believe, or actually more like 80%, it looks like, maybe 85. So we've talked about on the podcast before about how lending standards have been leading into this, and they've been really tight and they've been very conservative. And I think it's going to pay off for us in the long run.
Yeah, that really, it's telling. It says that the likelihood of some big crash, that some of the bitter people who missed the opportunity so far. You don't have to keep missing it, folks. You may have missed it so far, but remember, the game starts today, right? When's the best time to plant a tree? 20 years ago. When was the best time to buy a property? 20 years ago. Second best time? Today. Okay. So, you don't have to be one of these people who are bitter about missing the opportunity and you're saying, oh, there's going to be a crash. I'm waiting for a crash. And, there's just going to be this big crash and all these rich investors are going to lose their shirt. And that's when I'm going to jump in and do it. Don't be that person. It just never works.
Yeah,
the market timers in every market, just historically, they just lose. Stock market, real estate market, gold, precious metals, whatever, anything. Timing the market does not work. Stop it.
Yeah, go back and watch the last couple live streams Jason and I have done. We've gone over the numbers and shown you that it's not likely to win for you in the long run. Tim says here, the top 10 national builders have said on their recent shareholder calls that they have purposely curtailed the production to keep price escalation about 2 to 3% every 30 to 45 days. That that does not surprise me. And honestly, part of the thing is,
I got a comment on that, but go ahead.
I was going to say, part of the thing is they can do that because they don't really have much competition.
Well, okay. So Tim, that's an interesting comment. And I have no doubt that they said that or alluded to that. But remember, that's very dangerous talk because it almost could border on antitrust violations. And the beautiful thing about capitalism is it always discourages loyalty and discourages, or wait, what do I want to say? It encourages disloyalty.
Yeah.
So here's what I mean by that. If these builders get together and say, look, let's not build anything, so prices will just keep rising and we can make more money, nobody's going to do that because somebody will be the rebel and break because they're more greedy and they want the money now. That's the way competitive free markets and price discovery works. It rewards that behavior. So the likelihood, I mean, look, Adam, we could get together with my competitors and just say, hey, look, let's not put like inventory on our website, or let's all preach this idea that there's no housing. right? No inventory. Let's intentionally slow down sales, okay, so that prices will rise and we'll all make more money, us greedy bastards. But guess what? Nobody's going to agree to that deal. There will be some sneaky person who
Everybody will
breaks.
agree. Nobody's going to abide by it.
Nobody's going to abide by it because there will be somebody who will break and go to just undercut the competition. That's the beauty of capitalism. The free market works. So I just don't see that being any real thing, Tim.
Well, I don't. It may not be. They may have each individually said it. I doubt they came together and said, "Hey, we've all talked and we're not going to do it." But I could see them individually thinking, we're not gonna build.
Right. But Adam, individually thinking that does not work because they all have the pressure of their own financial obligations. And if they're publicly traded, they got the next quarter and they got an earnings report they've got to do. They got to keep that machine going. I don't doubt that there's a little bit of that there might be some thought to it, but by and large, I just don't think it's a big risk. Or a big thing that's going on. What's causing the problems is the government and all the regulations, environmental, and getting land entitled to build on, and all the construction rules and regs and so forth. But Tim, I'm glad you brought that up because it's a great point for discussion. So thank you for bringing it up. Gray Fox is asking you a question, Adam.
How can a business-centric person be a Dem today?
Yeah, Adam, tell us.
I am. So if we really get down to it, am I a Democrat? I'm probably farther socially left than Democrats are. And I think I can make money and still do the, Medicare for all and all of that stuff too. So, that's kind of how. I don't agree with, I don't like Joe Biden. I will be honest. I don't like Joe Biden.
Who could possibly like Joe Biden except Kamala Harris, who picked her, so she could be president when he has to go in 2 months.
So I'm kind of a Democrat, but I don't. Since I believe in the MMT framework of money usage, I can't support what Republicans often say we need to do, which is cutting spending in a lot of places. And I don't agree with that.
Well,
so that's how.
Adam and I disagree on these things. I think he's out of his tree, but he, at least he thinks about it. He's not like a knee-jerk Democrat. He really does think this stuff through. He's got an intellectual point of view. He's studied modern monetary theory extensively. He's very informed and up on the news and so forth. And another thing you got to remember is no matter what we try to think of ourselves or our own self opinion, we are definitely influenced by our environment, including the people in our environment and the place we live. And remember, Adam lives in a liberal city. Okay, Austin is a liberal city, and you're going to be influenced by it. Okay, if you were to move to a really conservative city, I bet over time your views would change. No, am I wrong?
No, it's
no.
I highly doubt it. I highly doubt it. And Ray also asked, Germany tried MMT, didn't they? They're part of the Eurozone, and so no, they don't control their own currency.
Well, but what are they? What is that reference? What is Gray Fox's reference referring to? Is it like Weimar Republic Germany? I haven't thought about that. That was a great inflation story of the Weimar Republic post World War I.
Weimar doesn't work. That example doesn't work.
So there was no MMT?
No, because what happened in Weimar is their productive capacity was absolutely destroyed in the war. And then they owed reparations, not in their own currency.
Right.
So they didn't owe it in their own money. They owed it, I think, in
well, they couldn't pay it in Reichmarks, which was their
they owed it, I believe, I don't know, somebody else's currency. I don't remember whose. But they owed it in a foreign currency. And when you owe money in a foreign currency, your ability to create money is destroyed in a lot of ways. You can't just print your way out of that without causing hyperinflation.
Which is exactly what we are doing to China, okay, by inflating our currency over time. But the problem is it's a race to the bottom where every currency in the world is inflating. But the US has the privilege, in quotes, of inflating more because it's the reserve currency and the biggest military and the biggest brand in the world and all the stuff I've taught you over the years.
If we owed money in yen or Australian dollars or pounds or anything like that, we would be in a totally different situation.
Yeah.
But we don't, so we're in a better situation.
Yeah, the US is in a very, very enviable situation. So this chart is showing the mortgage originations based on the credit score of the borrower, which should lead you to believe that the mortgage originations are pretty darn solid. Okay, PDS, pretty darn solid. Okay, because look at this. This is a FICO score of 760 and above. And that is the bulk on this chart of mortgage originations, okay, in the first quarter of this chart's a little bit old, which, is a bummer.
No, it isn't. That's the first quarter there. The next three lines are the next three quarters.
What do you mean?
So the far right of the chart is.
Oh, sorry, you're right. Okay, so that's this line or this one, right? And
then the very far line is the third quarter of 2020.
Okay, so here's Q2, here's Q3, and here's it can't be Q4 yet.
No, it ends at Q3.
Yeah, so this is Q3. So look at the originations. These are 760 and above FICO scores. That's phenomenal. And here's 720, which is usually 720 is the gold standard. That's enough. And there you go. Now we've got some at 660 to 719, not terrible, okay? And then we've got some real lower mortgages here of 620 and below, but that's like nothing. It's nothing, okay? But back here, you can see that there were a lot of these lower quality mortgages back in 2005, and then we know what happened, and you've seen the movie or read the book, The Big Short, right? So there you go. Okay.
Yeah.
Anything else on this?
If you look at how COVID has hit people, you think of you tend to think of people with higher credit scores as higher earners. That's it's not tried and true, but it tends to somewhat correlate. And the pandemic has hit different groups differently. So as Jason's talked about the K recovery that we've had a lot, the upper end has recovered a lot better than the lower end. So those top loans are in a lot better position.
Yeah. So folks, the message here is the underwriting is much more solid than before. There's just not a big crash worry here in the underwriting component of the equation. All right, let's talk about building a portfolio in responsible markets, Adam.
Yeah, so if you want to go ahead and share my screen. So
what happens, by the way, while you are sharing your spreadsheet, I'm going to pull up a graph that is going to blow your mind, people. So get ready. I'm going to do that while Adam is sharing his screen. So let's stop sharing mine and let's share yours. There we go. So tell us about this spreadsheet.
Yeah, so this boils down to talking to some people about their potential 1031 exchanges and having California properties and wondering, what should I do? Should I, reinvest and go somewhere else? And this spreadsheet is essentially the pro forma that you'll see when you go to jasonhartman.com/properties and look at it. I've just recreated it to where I can run the numbers quickly on my computer and see if it's a good investment before it gets uploaded to the system. So I talked with one person who had an actual California property that is 1,245 square feet. They could currently sell it for about $675,000. It's currently rented for $2,900, which Jason, I think you'll agree is a poor RV ratio.
Yes, I will agree.
Their property taxes are about $5,000 a year. They pay about $1,000 a year in insurance, and then I figure you'll put in 8% maintenance, and it's an older home, so 8% maintenance, 8% management. Just kind of those are industry standards, especially for as old as this property likely is.
industry standards. They are our standards.
Right.
Because
well, I mean, but if you go around,
we are
when I say
more
industry, I mean like the
conservative
management
than the industry. Go
agreement.
ahead.
If you go around and interview property managers, you're going to be paying around 8%.
Yeah.
So,
Oh,
if they were
I
to
thought
take
you
out
were
a
talking about
mortgage
all
for
the
this property right
assumptions.
now,
Sorry, Adam. Yeah, go ahead.
if they were to take out a mortgage on this property right now, and they could get 3.625%, which the $500,000 loan amount is borderline jumbo loan, depending on what county they're in. So don't know exactly what rate they could get, but if they could get what we're getting on our properties, which is 3.5 to 3.75, their payment would be $23.45 just for principal and interest. So they would be losing almost $650 a month on this property. It has a negative cash on cash, obviously, a positive total return on investment just because of principal pay down and appreciation, which I have set at 6%, which is actually below where the US has been in the last year. So, but if you look at if they were to purchase this property today, they would have 25% down, closing and origination at 3.5%. They'd be in for around $192,000. So then I asked myself, well, with what we have now, what could you actually get for roughly $190,000 to $200,000? So I just went through each of our markets with our new construction and started picking one in each market.
Okay.
So I went with the first one is in Lincoln, Alabama. It's available right now. 192,000 rents for 1,395. I put 20% down on these because I know you can, and wanted to make my money go farther, honestly. And so at 3.625%, which is where everything's going to be, you're positive $246. You got a 6.5% cash on cash and a 38% total return on investment. I can buy that property, and then I can also go to Charlotte or the Charlotte area and buy one in Kannapolis. That's 205,000, rents for 1375. After all the numbers are pulled, you've got a cash flow of $202, 5% cash on cash, almost 37% return on investment. We're going to get to I'll sum it up pretty nicely in just a few minutes. Then we could go to Cape Coral, buy one of those that's available, pay for that, get all of that, $217, almost 5% cash on cash, almost 37% return on investment. And then I could go to Birmingham and buy a property there that'll make me $236 a month. So I could buy those 4 properties, and this is the total here. For those 4 properties, I would have put in $199,000. I would have had $5,920 in rent instead of $2,900. I would get $900 positive cash flow. And my total return on investment, assuming 6% appreciation for everywhere, and the principal pay down and everything, total return on investment, 37% with a positive cash on cash of about 5.5%. So it's pretty much the exact same amount of money, but spread across responsible markets that make sense the day you buy it. And instead of losing $650 a month and banking on appreciation in California to get your return, you spread it across the country and get a much better, that's a $1,500 swing in cash flow every month. And it's a 15% increase on your total return on investment. It showed me quite a bit about what you can do. And that's obviously, you don't have to buy 4 in 4 different markets, but that's just right. Looking at new construction available now, what you could get instead of right. keeping or buying that new one in California.
And Adam, you're absolutely right, though. I mean, look, this allows people to diversify. They've got the best asset class, the most historically proven asset class, income property, but they're diversified geographically into multiple markets. They've got lower priced multiple properties. So if one goes vacant, they don't have 100% of their portfolio vacant like they would in that one property in California, for example. And the return is much higher because the rent to value ratios are much more in favor of the investor or the landlord in this scenario. So, and this is the basic plan we've done for many clients over the years, and I've done it for myself. Okay. So it's a great plan. I remember we had one client years ago who inherited a beach house in Orange County, California, and it was no big deal beach house, but it was like $2.7 million. They sold that. We helped them coordinate the 1031 tax deferred exchange, and I think they purchased. We did that. We had a couple of podcast episodes about them years ago, but I think they purchased 37 properties from that exchange, and they were diversified into several markets. I mean, they made a bundle of money. Versus had they kept that house, we demonstrated like how their cash flow, it just went through the roof. It was just such a better plan. And this RV ratio, rent to value ratio, 0.7 that Adam's got, very achievable, right?
Yeah, absolutely. And these are ones that if you were to sell that property, they would be available to 1031 exchange into. You'd be able to identify them as part of your process within the 6-month time frame that you have to close. So, right. I mean, I just wanted to show that. I mean, I shared this with all of the investment counselors. So whoever you're working with, feel free to talk with them, and they have the same spreadsheet where you can say, hey, what if I bought these 5 properties, and we could run the total numbers for you and get it. So everybody's got it. We can help you figure out what you can do with your money rather than, leave it sitting in. Now, I want to note, the investor is not dumb. They bought this California property a while back. It is positive cash flowing. It's just in today's market, it absolutely makes no sense.
But it's positive cash flowing only because they have a bunch of equity in it, and that equity is just sitting there, not working for them.
Right. Absolutely.
Yeah. Okay. Adam, thank you so much for creating the spreadsheet and sharing it with our entire team. So anybody on our team at jasonhartman.com can help you with this. They'll be happy to go over it. And Adam, we really appreciate you creating it. And folks, this is cha-ching. Are you ready for me to share my screen? I've got the big finale. Okay, here it comes. Here it comes. Let me show you a chart that is going to blow your mind. Are you ready, folks? Are you ready? Let's do drum roll. There it is. So one of our clients sent this to me yesterday. This was a tweet. I can't remember the person who actually tweeted it, but he said that 35% of all the US dollars in existence have been, they say printed, but really the proper word is created, okay, because they're created electronically in most cases. Some are printed in the last 10 months. And then everybody was bugging him on Twitter, show me the source, show me the source. So he had to post this chart from the Fed over and over again. It was like, cite your source, and don't just say that. So I felt bad for the guy, but he posted the chart, and this is again from the Fed. And here's what happened at the beginning of the year. The creation of fiat currency has gone parabolic almost. This right here and this up here is what they call the famous hockey stick. Okay, the hockey stick graph, right? Where it just it goes into outer space, and then it goes up again. And folks, there's even going to be more, because the next stimulus is coming, and we're all hearing about that on the news. So yeah.
And this chart is a great example of why, if you're shorting the stock market right now, you're going to lose, because fiscal flows capture everything, because the stock market doesn't care about how I'm doing or how Jason's doing or how the janitor is doing. It cares about corporate profits, and the money coming in, the fiscal flows from the government into the private sector coming out are huge. They're enormous right now. So the stock market, for now at least, is going to continue climbing. It is completely separate from reality.
Well, and Adam, really the same is true of any market, because that money just flows everywhere, right? It does it, it's not completely balanced, but it's certainly flowing into housing.
It
So
is definitely.
if you're sitting on the sidelines and thinking, well, I'm going to be the opportunist, the vulture capitalist, and I'm going to, pounce after the crash. I just, I'm not saying there will never be a crash. I'm just saying in the near term,
When
there's no crash, folks. I don't know where that's going to come from.
Yeah.
Because underwriting is solid. Certainly, broader things can happen in the economy. There can be terrorism, there can be war, there can be all kinds of things. But right now, there is a mass migration to good quality suburban markets. They're not building any low priced housing. Loan mortgage underwriting is very solid. And, people. It just looks like a good road here.
Yeah.
Anyway, I've got on the screen, scrolling across the bottom, our Alabama new construction property webinar. So you can catch that at jasonhartman.com/sweet home, like Sweet Home Alabama. So jasonhartman.com/sweet home. It's the bottom of your screen. And Adam, you've been looking at that market and you've done some business there, right?
I've helped some people purchase there. I haven't purchased there yet. And I just wanted to mention to people, when Jason and I are talking about lower priced homes, that realistically means below $250,000 in today's environment.
I know, isn't that?
They're not building below about 300,000 in general in the United States. So we don't mean $100,000, which they're really not building, but they're not building below 250 to 300.
Yeah. Yeah, so there is a mega shortage of lower priced properties, and so we've got new construction that you can get, sometimes under $200,000, which is amazing. And these are quality markets, quality properties, quality areas, and resale construction. They're few and far between, but rehabbed, rent ready houses. One of our clients just purchased one for just over $100,000. I mean, talk about something that can just never be recreated again.
Well, Tim,
that's investment security,
Yeah, Tim just went under contract for one that's under 100,000.
Wow. Where was that?
It's in Montgomery, Alabama.
Yeah, and folks, this is not Detroit, okay? These are quality markets. So
a real city that has real people in it.
Yeah.
And real industry.
Yeah, right. Imagine that, and good politics, politics that Adam would disagree with. What do you think about that, Adam? That bodes well for the market, right?
I feel like I'm getting kicked while I'm down here.
Oh, come on. I'm just giving you a hard time. Hey, don't give Adam a hard time in your comments, folks. He's an intellectual. He's a good guy and does a great job. So let's wrap it up. Anything else we should share as we go? Check out the webinar. Of course, podcast 5 days a week on the Creating Wealth Show.
Just the podcast, and then definitely educate yourself with the webinars. I don't know about anybody else. We talked about it before the show. I'm probably going to be buying myself the Christmas gift of the asset protection with Bob.
Oh, yeah, that's a good idea. Yeah. And that one, I'll put that on the screen too. That's jasonhartman.com/protect. And folks, let me tell you something. You've got to do this. Just take care of business in terms of asset protection. Very, very important thing to do. And this is something you must do in advance. You must do it in advance, folks. So just take care of business and do that. And you will sleep much better and feel much better. Very important thing to do. You can check out that webinar. It's very educational, by the way. Even if you don't do it, you're going to learn a lot at jasonhartman.com/protect. And I am putting that in the chat right now. So without any further ado, Adam, let's wrap it up. Say goodbye, everybody. Thanks for joining us today, and happy investing to all. Thanks, Adam.